Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. No one really knows what to expect from Jackson Hole, which is what makes this conference so consequential. Steve Sosnick, chief strategist with Interactive Brokers, joins me to discuss what that uncertainty is and how it's reflected in the volatility complex. It's great to see you, Steve. As always, welcome back to Trade Talks.
Thanks very much, Jill. It's always a pleasure.
And it is always a pleasure on our end as well. Let's talk about Jackson Hole. It's finally here this week.
Yeah, I mean, this is what we've been waiting for. As a skier, I'm always jealous because these things are held in like Davos and Jackson Hole, although there's no skiing now, but they're always the best ski resorts. But this is a consequential one. Typically, it's a big focus this time of year anyway, because late August, it's big vacation week, it's end of the summer, there's usually some sort of doldrums. And so Jackson Hole is, exists for no other reason than to spice up traders' lives in the last week of otherwise a drear, end of summer type of trading. But this time, for real, we really have to pay attention to it because we're going to get no shortage of Fed speak. And one of the things we saw, I would say the last leg of this recent rally we had, which seems to be fading quite a bit today, but was really predicated on Powell's use of the word neutral in relation to policy at his press conference. And the market really seized upon that and loved the idea, despite the fact that he commented not a sentence later that he would expect to go to restrictive policy. And despite the fact that basically all the various Fed speakers who've come since then have pushed back on this neutral idea. So I think we're going to get the possibility for a really divergent set of Fed comments coming out over the course of this conference, because there's not a great consensus right now. Is it 50 or 75? What about the path of quantitative tightening? We're scheduled to accelerate that. Do we see that persisting? And if so, how long? Do they even see the potential to accelerate it further? The number of variables is really high this time around. Well, when you have a lot of variables, that leads to volatility because that's literally uncertainty. Right. And that's what we'll have to see.
So, Steve, when we take a look at the volatility complex, whether it's VIXN, VolQ, VIX, are you seeing anything there that can potentially give us some clues? Because we also have this seasonally busy time for volatility coming up in September and October.
Yeah, we've seen most of the major volatility indices sort of trading around their lower levels for the year. Going back historically, VolQ doesn't have the history that VIX does. So I'm going to switch here a little bit to VIX. VIX is a bit above its long-term median or mean, but relatively low given where we've been since the start of the year, when we've generally been in a declining mode with some sharp uptrends. And the same applies to all the other volatility indices. We've started to see them pick up today. Now, interestingly, when I looked earlier, the differential between VIXN and VolQ, which I look for, which, as we know, VIXN includes the wings, VolQ is basically the three around money strikes at any given time. That relationship has been fairly stable today, which means people are not racing for pressure, looking for protection or speculation in real out of the money options. But just in general, there's a higher volatility theme. Remember, these volatility indices are meant to be the market's best estimate of volatility over the coming 30 days. Well, in August, usually it's anticipated that not much happens. We've actually had a very eventful August. It's usually anticipated that September, something does happen. September has a way of something freaky happening, either September or October or both. So as we start to approach September, the volatility indices that you see now are reflecting pretty much, almost exclusively September in there. They're called 2/3 September. And so we would normally expect to see these indices pick up even without Jackson Hole. And so on top of it, we've got a catalyst for volatility. So that's why I think we're seeing a bit of a bump today across the volatility spectrum.
Yeah, not to jinx it, can't imagine anything freakier happening in 2022. And of course, we still have 4 months to go. Let's talk about some tactical trading here. And we've brought this up before about the massive influence the heavyweights of the Nasdaq 100 have. And as go those stocks, there goes the Windex. It's almost, to your point in your notes, the beta version of what we see in the S&P.
Oh, yeah. I mean, I've been doing some statistical work on the two. Basically, at this point, NDX and SPX are quite heavily intertwined. I mean, the same 5 stocks make up the leadership of both indices. It's over 40% in NDX, it's over 20% in SPX. And so they really have to be intertwined to a large extent. I mean, S&P 500 includes basically the Nasdaq 100 plus 400 other stocks, oversimplifying, but that's the case. And so what I'm finding is the correlation has been very high between the two, and that's normally the type of tradable relationship that we like to see as traders. But what it means, even if you're not doing sort of a pairs trade where you're buying one, selling the other, what it means is Nasdaq, if you want broad market exposure, Nasdaq is the NDX complex. I'm going to use NDX, QQQ interchangeably here. That's probably your better way to do it, because essentially NDX is the higher beta version of the broad market. If you assume that SPX is the broad market, well, NDX is getting you essentially similar returns. They're going to move one way or the other. It's just that NDX is going to do that with much more volatility. So what that means is you can either, if you're a trend follower, if you have a very strong view, those are 2 reasons why you'd probably be gravitating toward the NDX complex. If you're a bit more risk off, well, then you may want to lighten your exposure in NDX QQQ. Or if you want to gain exposure, let's say, to financials and energies, by definition, NDX doesn't have financials, and just by the nature of their listing status, doesn't have energy either. So there are very valid reasons to be moving between SPX and QQ, call it SPY and Qs, on any given day. And that's not just for traders, that's for investors as a whole. The correlation is extraordinarily high right now, but the Nasdaq complex definitely provides you more beta, which means you're going to be moving more than on any given move. You're going to see it more, and that's not a surprise. NDX tends to move more than SPX on any given day, and the volatility indexes reflect that as well.
And Steve, let's wrap up with the freakiness of 2022. Help us unwrap what's happening with the meme stocks.
Okay, I wrote a piece here, and I'm sure this will annoy people, and that's not my intention. My intention is to protect people, but I do think a lot of people unfortunately got bamboozled in this latest round of meme craziness. Now, the memes, you don't tend to see memes perform as well as they do when you don't have a sort of some sort of market froth or health to it, right? If nobody's looking to buy stocks at all, they're certainly not looking to buy meme stocks. But when markets get a bit frothy, those come back into play. In the case of Bed Bath & Beyond was really the catalyst here. And while I have to be very careful not to cast any aspersions, I will say that I thought it was a well played move by a specific investor who was long and wrong, who was long over 10% of the shares, and watched them go from over 15 down to about 5. What does a normal person do in that situation? You either have to suck it up or decide whether to buy more based on fundamentals, but you're looking at a loss. If you have a huge social media following, you can go out and buy a big slug of options and create excitement in the stock, make filings to that effect, and then unfortunately for the people who come in a few days later, he basically sold the stock to them. My feeling here, this reinforces my feeling about meme stocks, is if you want to trade them, treat them like you're going to the track or something, because this is money that you can lose very easily. And so don't use any money that you wouldn't feel okay without a total wipeout, because that can happen to you, particularly if you're buying the options on these things. Mm-hmm. What I would say here is, my point of that was there was somebody sort of, I'm not going to, getting the machinations of this going, and it was to benefit his own holdings. Now, plenty of people won. We read the story of the guy, he was a customer of our firm, among other things, yeah, who made $100 million. Now, granted, he started with 25 million, but still, that's a hell of a return. But so people do make money, but you have to be early and nimble. I think if you're just going based on the hype, realize that if you don't know who's getting played, it's probably you. And so again, if you want to do it, I can't tell you not to if you're an adult, But what I can say is fundamentally, most of these stocks are quite overvalued. You know, they're very exciting from a trading point of view. They're hard to borrow, so they're subject to short squeeze. But be very careful.
Yep, and that's fantastic advice, Steve. Appreciate it as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.